Well, good morning, everybody. And my apologies once again for not being there in person with you. But I think I'm getting better each day. Thought I'd be in today, but just not quite. So let's get started with a couple things here. So let me share my screen. Start with a couple this course announcements here. So if we look at the syllabus, okay, coming up. So Mike's Bikes, the single player simulation is due this Monday. I sent an email reminder about that the other day. So that's you working by yourself, going through 8 rounds. And your goal, if you want to get the full 100%, is to score at least 100 for shareholder value. So several players, excuse me, have already done that. And again, just keep in mind, don't panic. I know like after 5 rounds, I think I'd written to somebody yesterday that I was only at $47 after 5 rounds. And then it just, starts going up pretty quickly after that. Okay. That's the first thing. You got an NVIDIA 10K project due. So let's take a brief look at that. So let's do a week from this Monday. So you can find this by going out to, excuse me. Going out to the Blackboard, going to NVIDIA 10K assignment. And here you see it. And here's the link to the assignment itself. So we'll click on that. Okay. So there's 10 questions that you need to answer. Okay, and here's the directions up top. So you're going to use their 10K. I'm trying to be very specific about this, that you use the 10K, not their annual report, which has the 10K inside it. So for each answer, give your answer and also what page number you found it on in the 10K. Okay, and as always, you're free to use AI for help with this assignment. If you do, all I ask is that please send me the prompts. I'm always curious as to what sort of prompts will get the answers you're looking for. Okay. So about this 10K, let's go out and see where you can find this. So we talked about the other day, perhaps the easiest thing to do is just type the name of the company, go to their main page. Here's NVIDIA, certainly in the news. Seems like every day they're in the news, but some big news yesterday for NVIDIA. And what we want is this investors section. So if you go to investors, what we want then is financial information. We want to go to SEC filings. So if we go to SEC filings, I'll limit it to 2025. And for all form types, I'll make it annual. And there's the 10K. You bring up the PDF. And put this in. Okay, you scroll up. There's their 10K. Okay. Now, the other thing, as I mentioned, we go back here. If we look at financial information, there are these annual reports. And they have this annual report. And this is more of a glossy document, at least up front, that talks more about the company, its products, its services, really a chance to brag about how well they're doing. So here's their annual report. Then if we scroll far enough through this, should have checked how far down it was. I did this before, so here's the 10K that's inside it. So again, I don't want you using this version of the 10K. I want you, it's the same one, but just for page numbers, I don't want you using this document. Just use the real 10K that you can find on NVIDIA's website. Okay. All right. So there's that assignment. And this will start coming due. If you look at the syllabus, that's due a week from Monday. And then starting a week from today, we'll start on the team-based simulation. I posted your teams for the simulation up on Blackboard. And so the way class is going to work on those days where it says round one, round two, that's all we'll do that day, really, is just have you sitting with your team working on the simulation. You may get all the way through it during the 50 minutes, or you may need some time afterwards. And then the due dates are always, if you go down here, here's all the due dates. I tended to make them the day after you worked on the simulation in class. That's the due date. So here's all the due dates. These will all be pre-programmed in. Send it all out to SmartSims. They're setting it up for us. Okay. So there's, again, just some basic information about what's coming up. And again, on those days we're working on simulation, no personal days can be taken during those team days. Okay, so again, no personal days on days where we're working round one, round two, etc. Right? All right. Let's get into the new chapter, chapter 18, on our first of two chapters on finance. When you think about finance, there's three basic areas of finance. There's financial markets and institutions. That's understanding how money flows around the world, right? How central banks operate, how our banking system operates, how the Federal Reserve operates, and monetary policy and the like. So that's all financial markets and institutions. And institutions are, large investors like Vanguard, Fidelity, TIAA-CREF, California Pension System. So those are the institutions. Okay. And you can take a course later on called Money in Banking, where you delve more into the nature of financial markets and institutions. Then we have investments. Perhaps the first thing most people think about when they think about the world of finance is the world of investing, right? So that's Wall Street. That's understanding how stocks and bonds operate. So we'll get into that a little bit as well. And then business financial management. That's looking at individual companies and how they run their financial function. So when you take your finance course next year, your intro to finance course, the focus of that course is primarily on this last one, business financial management. Okay. All right, so there's, again, some basic stuff here. Some of these slides, again, we don't need to spend much time on. So what is finance? We can see a definition there and some of the activities that they perform. There's some of the who's who in finance. Again, the top of the heap is the CFO. CFP is, as the name implies, this is someone who works with individuals, help them plan their future, the retirement goals and the like. Chartered financial analysts, CCO, comptroller is often considered the top accounting officer. There's treasurer. There's many functions within the world of finance. This graphic showing all the variety of tasks that financial managers engage with. Okay. And again, it's perhaps no surprise that one of the main reasons that firms fail is because of financial problems. Here's some of those common financial problems. Undercapitalization is simply not having enough funds to do what you hope to do. I know when I was buying my business, they do a fairly rigorous background check to make sure that you can finance the business past the initial startup stage, where again you're going to be bleeding money, and you're going to be able to keep the business running. So a lot of people will start a business thinking they're okay now and don't realize how much money they actually need, and as a result, they just don't have enough, and they have to shut their doors. The next two are sort of related to each other. Not controlling your cash flow. Cash is certainly the lifeblood of any business. Without cash, you're not going to survive. And so not manage your cash, keeping track of when you expect some cash to come in, when cash is scheduled to go out. That's a critical thing. So that's part of the budgeting process we'll talk about later today. And then not having control over your expenses. Right? Are you managing your expenses, keeping your costs as low as possible, and the like. So financial planning, we'll look at both short-term and long-term financial planning. So short-term financial planning is trying to predict for a year and less your revenues, your expenses, your cash flows for a year. And then longer term, also looking at projected revenues, expenses, and cash flows, but it's for a longer time period, 5 to 10 years. So budget, I think most of us know what a budget is, right? And so companies use them as well as a way to project what the future will look like, as a way to project what their needs will be in the future. If it looks like sales are growing quickly, they may have to do some things with inventory management and start ordering more and the like. So that's all part of the budgeting process. And the budgets that are prepared mimic the financial statements that we talked about in chapter 17. So budgeted balance sheet, budget income statement, budgeted statement of cash flows. Those are your typical budgets, right? So here are ways to classify those. So a capital budget is one that looks at what we call CapEx. CapEx stands for capital expenditures. So these are trying to manage those major purchases. Obviously, they don't happen, on a daily basis, but they happen enough. They've got a plan for them and make sure you have the resources to be able to make those major purchases. So that's a capital budget. And that's by its very nature, longer term in nature, going out more than 1 year. And that's where you start doing things like using time valued money, trying to estimate, is this asset purchase worth it? What are the cash flow savings or increases that we expect as a result of this major asset purchase? And we need to discount those cash flows back to today and compare it to the cost of that asset. So capital budgeting is using a lot of time valued money concepts that you have a working knowledge of at this point. Cash budget, as the name implies, usually relatively short-term a cash budget. Okay, looking at our cash inflows and outflows, and it looks like there's going to be a shortfall. Then start planning for short-term borrowing. How are we going to get the cash that we need? If there's a windfall, what are we going to do with that extra cash? We're going to invest it somewhere for the short term. That's all part of the cash budgeting process. And then overall, we have the master budget that ties all these together. So master budget has the balance sheet, the income statement, the cash flows, the capital budget. So it's a place to find all the budgets for the firm. So back in the chapter on management, we talked about the 4 functions of management. One of them was the control process. We talked about control process is really a process of setting some standards, then measuring performance during the year, at the end of the year, comparing performance against those standards, and then making changes moving forward. So a big part of this is financial controls. Okay. And so again, financial control is just what we said. It's looking at your revenues, expenses, and the like, creating a budget. Then at the end of the year, comparing actual performance against that budget, see how well we've done. Where do we have some problems? Where do we have some successes? And then making changes moving forward as we prepare the next period's budget. Okay, so that's the financial control process from a budgeting standpoint. All right. So what do firms need money for? It's fairly obvious. You need it both short-term and long-term. You need it day to day just to pay expenses as they come due. You need to manage your cash coming in and out, buying inventory, and then those major purchases that are much more long-term in nature. But certainly we need to think about those as we look at our operational needs. All right. So virtually all businesses conduct business, and here we're talking about, for the most part, business to business transactions. Um, Most of those are done on credit, on account, as we say. Okay. So when Sony sells to Target a bunch of TVs, Sony will sell those TVs to Target, and they'll typically give Target like 30 days to pay. Okay. So that helps keep customers like Target happy. It may help attract new customers because, rather than having to pay for it right now, wouldn't it be nice if you get those TVs now and you could sell them and use those proceeds from the sales to help pay off the TVs that you just bought? So that overall, what we call cash operating cycle. This is going to tie up assets. So back in the last chapter, you learned about accounts receivable. That's the amount that customers owe us. So from Sony's perspective, they sold all these TVs to Target on account. So it creates, an amount in accounts receivable for Sony. And Sony needs to stay on top of that. They need to make sure that if the terms of the sale were 30 days, that Target does indeed pay in 30 days. If not, that's where you get into, contacting the firm, asking what's going on, and managing that process. So again, I think in an ideal world, companies would love to just sell using cash. But the reason they don't do that is because once you start offering sales on account, it's typically a way of increasing sales, attracting new customers, because customers would prefer that. So companies have to take the risk of selling on account that some customers may not pay, right? No matter how well a good background check you do on the company's credit history, it's inevitable that some customers that you sell to an account don't pay you. And we need to, build that into our cash flow projections. So some companies may allow credit card purchases as opposed to selling on account. Credit cards come with an extra fee that the selling firm has to pay, although I'm sure you've noticed that many firms now are passing that on to the consumer. They're adding that credit card fee to the actual cost of you've gone out to dinner or something like that. You'll see that fee added to your bill. So again, companies are trying to manage their costs, and that 2-3% on credit card sales, that's significant. It's 2-3% of all those credit card sales. Adds up to a lot of money. So perhaps no surprise we see companies doing that. It's annoying, but it's perhaps no surprise that they do this. And we're seeing more and more companies using and accepting mobile payments. I'm a big fan of using that myself as a consumer. Right? Inventory purpose, another, if you're, a retailer, then making sure you have adequate funds to constantly replenish your inventory is a key budgeting need. And so that's where just-in-time inventory control is going to play a key role. Ideally, you get your inventory in just before customers come in the door to buy it. That way, you're not out the fees to perhaps pay for it, or even if you're given 30 days, ideally, you get the goods in today, you have 30 days to pay it, and ideally you'd sell it before that 30 days are up, so you have the cash to pay it when it comes due. So when your inventory starts hanging around a little too long, that's where you start to get in trouble, because you've got bills to pay, your inventory is not selling, where are you going to get the cash to pay those bills? So inventory management is a critical function from a financial perspective. And I said before, capital expenditures, these are major investments. And, last chapter we learned about those non-current assets, land, buildings, equipment, both tangible or intangible. So these are major purchases. And so we take a longer time horizon. And that's why we start getting into things like time value of money. More short-term purchase, like for inventory, inventory is in and out, certainly, hopefully within a year. So there's really no need to get concerned with time value of money when we're dealing with inventory purchases. But with these capital expenditures, certainly there is. Okay. So there are two basic ways firms can acquire funds when they need them, right? There's debt financing or equity financing. The key difference, debt financing is when you borrow, which means you have to repay it at some point. Equity financing is where you raise capital either internally by doing your business doing well and you're using the funds for your business. That's really equity financing. Because again, if you think about the firm's doing well, it's generating positive cash flows, generating income, whose income, whose cash flow is it? It's the owners, it's the equity holders. So again, using those funds as a source of capital is really considered equity financing. And then obviously going out and selling stock is another type of equity financing. Okay. And within this, we talk about short-term financing, again, funds needed for a year or less. And long-term financing, we need funds for more than a year. Excuse me. So we talk about short-term financing. Perhaps the biggest use of short-term financing is what we call trade credit. So trade credit is exactly what I talked about a few minutes ago, talking about when Target is buying TVs from Sony on account, on credit. Okay. If you think about it, that's really a form of debt financing. They're, getting something now and paying for it later. When you think about that, that's really debt. Sounds similar to debt. Okay. Now, as an incentive for companies to pay, perhaps earlier than the due date, they'll often sell on terms, as you see written here. The way we'd say that is 210 net 30. We have to say the slash in there. So just 210 net 30. And what the 210 net 30 represents, that means that, let's say Sony sells the Target today, October 31st. If the terms are 210 net 30, that means Target, if they pay within 10 days, they'll get a 2% discount on what they owe. Otherwise, if they don't pay within those 10 days, then they have 30 days to pay the full amount. Okay. This can be significant. Won't do the calculation, but that's roughly about a 36% benefit to Target for taking advantage of those, if they were 210 to 30. The way we get, I won't get into it, but yeah, that's roughly about 36%. Well, let me explain it. So if you're Target, there's 2 days you would think about paying. Either pay on day 10, there's no need to pay before that. Might as well wait as long as you can to hold on to your money. So if you bought something today and you want to get this 2% discount, it makes sense. Well, wait the full time, pay on day 10. If you don't pay on day 10, it would be crazy to pay on day 11 or day 12. You're going to wait the full time. So you'll pay on day 30. So the options really pay on day 10 or pay on day 30. That's a 20-day difference. So you're getting a 2% discount by paying 20 days early. If we annualize that, think about how many 20-day cycles are there in a year. And if we just use 360 days as a round off, there's 18 20-day cycles in a year. So to annualize the 210 net 30, that works out to be about, again, the 2 times the 18 cycles are about 36% a year. So it's significant. So even if you had to borrow to pay that off, it may be worthwhile. Even if you had to borrow 24%, it's worthwhile because you're saving 36%. That's trade credit, and it's how the world of business operates. Virtually all sales between business to business are done using trade credit. Another source of financing, obviously, banks. Banks obviously prefer to lend money to large established businesses because you would think less risk. And they're hesitant to lend to startups because there's greater risk of the company not able to pay back the funds they borrow. Okay. And certainly during tough times, we had financial crises back in like 2008, 2009. A lot of bank money just dried up. They weren't willing to lend because they felt it was just way too risky at the time. Okay. So that creates a problem for small businesses. They're looking for funds. They need funds to keep operating. They're struggling as well. And if banks aren't willing to lend money, they have to look somewhere else. So there are other places they can look, but banks are usually a starting point because the terms aren't necessarily outrageous that banks would charge in terms of the interest rate. Right? So just want to make sure you're familiar with these different terms. So first off, when we talk about loans, so a loan is where you go to a bank and you borrow, let's say, $10,000, and you have the $10,000 immediately available to you, and you start paying interest immediately on the $10,000 that you borrow. Okay, so that's how a loan operates. And loans can either be secured or unsecured. The difference is there anything backing the loan? In other words, when your family's bought your house, they probably took out a loan for it, took out a mortgage, and most likely the house is the collateral. That if for some reason your parents stop making payments on it, the bank can come in and take over the house. They can foreclose on it, right? So the house, that's a secured loan. Unsecured, there's nothing backing. If a person defaults, a business defaults, the bank has no recourse to go after them, no assets to go after. Okay? A line of credit is different than a loan. Okay? A line of credit, let's say you go to the bank and you apply for a $10,000 line of credit. I always recommend, I think that's one of the first things you should do when you graduate, and you got your first job, make a connection with a local bank or a bank close to you, and set up a line of credit, even if it's $500, $1,000. It's just good to start establishing these sort of things. So the way a line of credit works, let's say you apply for a line of credit for 10 grand, you get approved. That money is sitting there. You haven't used it yet. It's sitting there. And as a result, you're not paying any interest on it because you haven't used it yet. But let's say a few months down the road, you're faced with an emergency car repair and it's $2,000. You don't have $2,000 in your checking account. So you now tap into this line of credit. So you would write a check for $2,000 from that line of credit. And now you start paying interest on just that $2,000. And you start paying back the $2,000. Then at some point when it's all paid back, your line of credit is back at the full amount of $10,000. So creates lots of line of credits, create lots of flexibility. You may set up a line of credit and perhaps never use it, which is fine. They don't really cost much or anything, depending on the bank that you use. But it's nice. It gives peace of mind knowing that you have access to this cash quickly in case you need it. Right? So that's the difference. A loan, when you borrow, you're given the funds immediately. You start paying interest immediately. Line of credit, you only pay interest if you actually tap into the line of credit. Factoring could be another source of funds on a short-term basis. Factoring is when a company sells its accounts receivable, right? So let's say on your books, customers owe you $100,000. And maybe they're hopefully going to be paying you within the next 30 days or whatever the time frame is. But you're struggling to collect them perhaps, or you just need cash sooner than how much time you're planning to wait for your customers to pay you. So there are companies out there called factors that actually buy your accounts receivable from you. Now, the thing is, they're going to buy them at a discount. They may offer you 80% of the value of the receivables. And in exchange for that 80%, you're giving them the right to collect all those accounts receivable. So it's a quick source of cash, but it's a fairly expensive form of financing, right? Because that 20% different, that's fairly significant that you're losing out on the value of collecting those accounts receivable. So again, that's where the factors make their money goes on whatever fee they're charging you for collecting those accounts receivable on your behalf. There's something known as commercial paper. So commercial paper are these typically issued by large companies. These are unsecured notes, right? Borrowings that come in amounts of 100,000 and due in 9 months or less. Okay, so let's look at an example here. So Apple got their 10K from a couple years ago. All right, so here's their commercial paper. So again, almost the exact definition we see in their slides. Unsecured short-term promissory notes. So again, we promise we're going to borrow money. So if you're an investor, you can lend this money to Apple and they will pay you back, but it's unsecured. You know, if they don't pay, there's nothing you can go after. So it's just the reputation of the firm you're lending the money against. Okay? And we can see what they're using this for. So they're using this for general corporate purposes, including dividends and share repurchases. As we mentioned the other day, talking about in accounting, Apple has been involved in a major share repurchase program over the past several years. And in terms of where they're getting their funds from, looks like many times they're issuing this commercial paper. We see that, you know, the rates anywhere from 5.25% to 2.3% they're paying. So it's perhaps a little bit better than you can get on other short-term opportunities to earn interest. And it's, you know, it's Apple, so it's highly likely they're going to be able to pay you back what they borrow. Okay, so there's commercial paper. Then certainly credit cards can be a form of short-term financing. You know, you can take out cash using your credit card. The problem is it's a fairly expensive source of short-term borrowing. I certainly experienced that when I was running my business. There were a couple of months where, you know, just hitting cash crunches, looking around like, you know, where are we getting cash to make payroll? And sometimes I had to borrow against my credit card. So it's expensive. The interest rates are high. You have to pay a fee on top of it. So you like to avoid that, but sometimes, you know, if you need cash quickly, credit cards could be a viable source of cash. For a startup, you know, we talked a little bit this when we talk about entrepreneurship, but lots of places you can get capital as a startup. You know, angel investors, venture capitalists, and the like. Then there's something known as microfinancing. This is where you're looking for really, really small amounts of money. So let's look at a classic example here. This is Grameen Bank. Grameen Bank was started, I don't know, back in '70s maybe, by Muhammad Yunus. He won Nobel Peace Prize for his work lending small amounts to people in developing countries. Here's a little story about it.
Jody Von Pop, one of your bonds, in December of 1979.
So to me, that's pretty impressive. Um, the willingness to take money out. And again, first off, can you imagine going to a bank in the US saying like to borrow $10? They would laugh you out of the bank. But that's what Grameen Bank does. They lend small amounts of money to places like this, and it's great to see these people taking advantage of it in developing countries. And the records seem to suggest that it's more women they lend money to. Um, and the payback rate from loans through Grameen Bank is much better than from a traditional bank. So it seems to be a win-win for everybody involved. All right. We move into long-term financing, right? The long-term borrowing can take out a long-term loan from a bank, like a mortgage. So a term loan agreement, like a car loan or anything like that, you agree to pay X amount every month. And as we saw when we did time valued money, part of that payment is going towards interest, part of the payment is going towards the loan itself. The advantage of debt financing like this, the interest that you're paying is tax deductible, which means it'll help you save in taxes. Okay. And certainly at play is the old risk return trade-off. Banks, they'll lend, but if they think you're risky, they might still agree to lend to you, but they're going to charge you a higher interest rate, right? So it makes sense, right? If you're greater risk, then the trade-off, the bank wants to see a potential greater reward from being able to charge a higher interest rate. Another form of debt financing is bonds. So again, if getting a loan is going through a bank, borrowing through issuing bonds is sort of avoiding that middleman, the bank, and going directly to investors. So this is sort of borrowing that you go through Wall Street for. Right? So a company may decide to issue 20-year bonds paying 4%. They'll go to Wall Street to help them with that process. And then you, as a potential investor, might say, I'll buy one of those bonds that Apple just issued. Okay. So we'll learn more about bonds in the next chapter, but bonds are a form of debt. Bonds, just like other forms of debt, could be secured or unsecured. The vast majority of corporate bonds, what we call debenture bonds, are unsecured. The only thing backing them is the reputation of the firm itself. All equity financing is long-term. The first equity finance we think about is issuing stock, right? In exchange for some ownership in the business, we get some capital from an investor, right? So that's equity financing. Using your retained earnings. Again, we talked earlier that, when a company is profitable, those earnings are really the owner's earnings, right? The shareholders. And so companies have a choice what to do with those funds. As we talked back in the last chapter, they can keep them in the business and it builds up retained earnings, or they pay those out as a dividend. The reason they may keep those funds in the business, keep building up retained earnings, it's a great source of capital for growing the business. That's why you often see most startups aren't paying a dividend for several years, but they're using their profits to help grow the business. Okay. Then there's certainly venture capital. Okay. And we talked about venture capital before, and here's just an interesting article if you've been curious. What's the difference between angel investors, VCs, the different series A, B, C, what's an IPO? You can read that particular article if you'd like. So comparing debt and equity. So when you borrow, which is debt financing, that creates what we call leverage. So if we say somebody's highly leveraged, that means they've got a lot of debt compared to their assets. Okay. But I want to make sure I stress this. Debt in and of itself is not a bad thing. It's neutral, right? Debt is neutral. Where it becomes a problem is if companies or an individual take out debt and they can't pay it back. That's problematic. So obviously you have to make sure that if you're going to borrow money, you're able to pay it back. And for companies, debt can be a great source of financing. It's a great way to leverage your business and to help it grow without having to give up any equity in exchange for it. Right? So yes, taking on more debt makes the firm riskier, but again, it may be a great way to grow the firm. Okay. Companies will look at something and they'll calculate their cost of capital. The cost of capital is the rate of return a company must earn to meet the demand of both lenders and equity holders. So it's often referred to as WACC, W-A-C-C. You'll learn more about this in your finance course. WACC is the weighted average cost of capital, and it's weighted between your mix of debt and equity. We often think of debt, there's clearly a cost. With debt, you have to pay interest. We're thinking, well, with equity, why is there a cost associated with equity? It's because they expect a certain return, right? They're investing in this company, and they could invest at this company, or they could invest it in bonds. They could put it in the bank account. So by investing in your firm, by buying stock, they're expecting a return. And so that's really part of the cost of the capital, that expect the return that both your equity individuals and your lenders expect. All right. So here's some comparisons. So as a debtor, you have no influence over how management is run, but common stockholders get the vote. Debt matures, stock does not. You have to repay debt, never have to repay your equity. There are yearly obligations in terms of interest payment, but the firm is never legally obligated to pay a dividend. The interest is tax deductible on a loan, but dividends are not tax deductible. So there's the pros and cons of each one. So let's look at an example here with some numbers. Right. So here's two companies. They both needed $200,000 of additional financing. This first column decided to take out additional debt. So we see this $200,000 right here. This firm decided to issue additional equity. And let's see the benefits of this, if they're able to put that debt to good use. The debt is at 8%. So here's what happened. Each firm had $100,000 of gross profit. This company had to pay interest, 8% on 200,000. That's the 16. So their profit is less, 84,000. This is 100,000. Remember one of the ratios we talked about in the previous chapter is return on equity. Notice that because they use debt, their equity is lower here. And so that results in this example having a higher return on equity. So that's what we would call a good use of debt. You're able to borrow that $200,000, put it to good use, help to generate profits, right? And then the profits they generate, it's greater than what they're paying in interest. So overall, it's a way for companies to boost their return on equity without having to give up any additional ownership. So let me show a quick example of this using an Excel spreadsheet. And this is the last thing we'll look at. And again, this is a little bit longer. I really don't know how long this has been going, but I should have checked that. But certainly you can stop this anywhere, go back and finish it. But it'll be nice. We'll be done with this chapter. So here's a spreadsheet I put together. And we'll do it in terms of a house. I also do it in terms of business over here with assets, liabilities, and equity. So a little balance sheet there. But let's think about a house, okay? And why houses, for many people, for many investors, are a great investment opportunity, right? So let's say you're looking at a house that costs 50 grand and you're going to buy it. And typically, banks want you to put 20% down. So you put 10,000 down and you borrow the rest, 40,000. Let's say the interest rate on that mortgage is 10%. Let's say the house goes up $5,000 after 1 year, right? So now the house is worth $55,000 if you were to sell it, okay? You have to pay interest, 10% of 40,000, right? So $4,000. So your net return, the house went up 5 grand, you had to pay interest of 4, overall return of 1,000. So we can talk about two sort of returns here. The return on the house. The return on the house is the return on the asset. So the asset was 50,000 and it went up 5,000. So this first 10% is simply how much the house went up in value divided by the original cost of the house. We'd say the house went up 10%. We got a 10% return on the house. In terms of our return on how much we put into this deal, we put $10,000 in. And at the end of the day, after paying off interest, right, there was a $5,000 gain. We had to pay $4,000 interest. So we're left with a net of 1,000 on our $10,000 investment. That's also a 10% return. So at this point, everything is sort of status quo. Lists are changing things. Let's say we try and we find a better interest rate. Let's say we find an interest rate of only 6%. Okay. If that happens, obviously we pay less in interest. Our return is greater. Notice the return on the house hasn't changed, but look what's happened to our return on the down payment. It's increased dramatically. That's one thing. Shopping for better interest rates can increase your return. Okay. The other way you can return this is to be more leveraged, to borrow as much as you can. Let's say we find a lender that's willing to just have us put $49,000 or $1,000 of our own money down. So we're borrowing 49, we're only putting 1,000 of our own money down. Look at what happens there at an interest rate of 6%. This really is a 206% return on our direct investment. So again, the house still only went up 10%, but because we're highly leveraged, we're able to take advantage of that and actually earn a 200% return on our investment. Okay, so that's again one of the reasons why real estate is a potentially popular investment, because it often gives you the ability to be highly leveraged and take advantage of what we're doing here. So everything looks great here. And the assumption seems to always be that, well, houses always go up in value, so there's nothing to worry about. Well, it's great when things work out the way we see them, but if the house were to go down in value, that's the problem. If this house It went down $5,000 in value. So the house dropped 10%. Look at our return now, and almost a negative 800% return on our investment. That's where it gets dicey. So real estate investing, considered a little bit risky because you're highly leveraged. You're borrowing a lot of money to purchase the real estate. That all works quite well if the value of the property goes up and you've got a nice low interest rate, but it could collapse if the value of the property goes down. And this is partly what explained going back to 2008, what was going on. People were borrowing lots of money and using that money to invest in, risky real estate investments with the assumption, well, real estate always goes up. Well, it didn't. Okay. And as a result, they potentially lost a lot of money on those investments. Okay. So there's both the power of being leveraged, of using debt, and also the danger of using debt. So that's why I say debt is neutral. It all comes down to how well can you use it, right? So that's it for this chapter. So we're finished chapter 18, and we can do 19 on Monday. So let me stop recording. So have a great weekend, and happy Halloween to all of you.